Welcome back to Investing Talk Podcast.
Today we're looking at Rubrik.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. Rubrik is, it's positioned right in the middle of this huge market defined by ransomware and, just data chaos.
And their recent earnings report, the Q3 for fiscal 26,
it
wasn't just good.
No, not at all. It was like a proof point, a really definitive one, that their whole business model transition is, well, it's working.
They delivered some really strong growth, even with all the macroeconomic headwinds that are slowing down some of their competitors.
And when you say definitive, they exceeded expectations everywhere.
Completely. The top-line revenue grew 48% year over year.
Which is huge, hitting, $336.4 million? And that number, came in a full 9% higher than their own guidance and the analyst estimates.
That kind of beat, that tells you something. It's not just good execution. It signals real demand for what they're selling.
But the volume is only half the story, really. It's the quality of that revenue that validates the whole investment idea here.
We're talking about the pivot.
Exactly. The pivot from, traditional software licenses to a subscription model.
Yeah.
SaaS. Their subscription revenue stream, that grew even faster, 52% year over year.
And for any company making that switch, that's exactly what you want to see. That acceleration in recurring revenue builds predictability. It's the holy grail.
It absolutely is. And that predictability, it shows up so clearly in their KPIs. The most critical metric for any subscription business is ARR, annual recurring revenue.
And they hit, what was the number?
They hit $1,347 million in subscription ARR. That's up 34% year over year.
Okay, but let's zoom in a bit because the real driver here is the cloud.
Oh, for sure. Their cloud ARR, so that's the revenue tied specifically to their Rubrik security cloud platform, that just surged 57% year over year to $1.1 billion.
So that confirms it. The strategic bet they made on being a cloud-native, zero-trust data security provider is paying off big time.
It's not just a successful switch to subscriptions. It's a successful migration to that higher margin, more strategic cloud platform.
Right. And when you see numbers like that, the management confidence just makes sense.
Of course. They didn't just meet expectations. They immediately raised the full-year revenue guidance
to $12,281 million at the midpoint,
which implies 44% year-over-year growth. That's a huge bump from their previous estimates.
And when a company in enterprise software raises guidance like that, it means they have, exceptionally high confidence in their sales pipeline for the next few months.
Beyond the growth, though, the whole story really shifted this quarter around profitability.
That was the big one. For a high-growth SaaS company that's always been about expansion, Q3 was the inflection point.
It was a massive surprise, wasn't it?
A huge surprise. The company reported a positive EPS earnings per share of 10 cents.
And their guidance had predicted a loss of 17 cents per share.
That's a 27-cent swing. That's just an operational triumph. It tells the market that the scale they've achieved is finally creating real leverage.
And this is key. It wasn't just some accounting trick. The cash flow followed right along with it.
Which is the real proof.
Exactly. Free cash flow, it turned decisively positive. It hit $76.9 million in the quarter.
And if you compare that to last year, it was only, $15.6 million?
Right. A five-fold increase in their ability to generate real, sustainable cash.
Yeah.
That tells you they can self-fund their growth from here on out.
So that brings us to the balance sheet, which looks remarkably clean.
It really does. They have these fantastic gross margins, just hovering around 78%.
78%. So for every dollar of recurring revenue they bring in, 78 cents is left before operating expenses.
Which gives them immense operating leverage as they keep scaling that cloud platform.
And their capital structure is pretty smart, too.
Oh, it's highly strategic. They have a strong cash position, about $1,523 million in cash, against debt of $1,150 million, which looks fine on its own, but the real advantage is how that debt is structured.
This is where it gets really interesting, I think.
It's all in the form of 0% convertible notes that are due way out in 2030.
0%. So they've secured over $1 billion in capital with basically no interest rate for years.
It's essentially free money to fuel growth. And the conversion price on those notes is set way up at $139.21 per share. So the risk of dilution is it's minimal for the foreseeable future.
It just shows some real financial savvy. Okay, so shifting away from the financials for a second, the real long-term argument for Rubrik has to be its competitive moat, right?
Mhm.
What makes their product so sticky?
It all comes down to their zero-trust data security architecture. This is the critical differentiator.
Oh, yeah.
They're pretty much the only vendor that integrates data security posture management, or DSPM identity resilience, and cyber recovery all in a single cloud-native architecture.
So let's unpack that, because most of the legacy providers,
Yeah.
the Dell EMCs, the Commvaults, the Veeams, they were designed for simple backup.
They bolt security features on afterwards, but Rubrik, they started from day one with a security-first, zero-trust model. It's baked in, not bolted on.
And that's a fundamental difference.
It is.
Yeah.
Their DSPM, for instance, lets you identify sensitive data exposure in real time. It's proactive, not reactive, like just copying files.
And the recovery piece is what seals the deal. They have this proprietary tech, the preemptive recovery engine.
Yes. And in an age of ransomware, the biggest fear is recovery. How do you get back online without just reintroducing the malware?
Right.
Their claim is that this engine allows for rapid, zero-knowledge cyber recovery. They can restore data to a clean point in time without having to trust anything about the network's prior state.
So they can guarantee a clean recovery. That's invaluable.
Yeah.
I mean, that's the difference between a minor headache and a total business catastrophe.
And you see this differentiation in their customer economics. The land and expand model is clearly working for them.
I'll say. They have over 2,505 customers now spending more than $100,000 in subscription ARR.
And that's up 27% year over year. These are high-value, sticky relationships.
The switching costs are just undeniable. If you're protecting petabytes of data with them, moving to a competitor is a massive multi-million-dollar headache.
Which is why their net revenue retention stays consistently above 120%.
So just to be clear, that means existing customers are not just staying, they're spending at least 20% more each year.
Exactly. And a big chunk of that, about 35% of that expansion, comes from them adopting more security features on the platform. It reinforces the whole moat.
What's fascinating to me, though, is how they're looking to the future, specifically with AI.
That's their emerging edge. The acquisition of Predibase was a brilliant strategic move.
Because as companies start using AI agents that can access sensitive data,
You create a whole new security vulnerability.
and their answer is this agent rewind concept.
Yes. So if an AI agent makes a mistake, whether it's from bad data or a malicious attack, and corrupts your critical systems, Rubrik can just reverse it.
That is a huge market opportunity. Traditional security vendors, they just aren't equipped for that.
Not at all. Rubrik is planting a flag in what could be a $1.8 trillion market that's barely being touched right now. It dramatically expands their potential beyond just data security.
Okay, let's shift gears and look at the technicals, because despite all this fundamental strength, the stock did see a pretty significant pullback from its highs.
Yes, and that's key context. The price over the last 6 months is down about 28.55% from its peak.
But the market's reaction to this earnings report was a 15% jump in after-hours trading.
Which suggests the pullback was just consolidation. It was caution before they proved the profitability.
Now that the proof points are there, the profitability, the cloud ARR, a lot of people see the current level as an attractive spot to get in.
For sure. There are key technical support levels that have formed around that $68, $69 mark. Analysts see that as a pretty solid floor.
And the institutional sentiment backs that up too. Analyst momentum is overwhelmingly strong.
I saw that. 16 out of 20 analysts are rating the company a buy or strong buy. That's a high level of conviction.
Yeah, and the consensus 12-month price target is up at $108.67. From current levels, that implies some pretty significant upside.
And looking ahead, you have several near-term catalysts that could drive that price up.
The first being the Q4 earnings report, right? That's expected around March 2026.
Yes, and management has already guided for a strong finish to the year. Historically, Q4 is their biggest quarter for new subscription ARR.
And second, after a beat this big, you have to expect analyst upgrades.
Oh yeah. We should probably expect to see 3 to 5 upgrades in December and January once they've updated their models.
And finally, the guidance for Q1 of fiscal 27. Management has a history of guiding conservatively and then beating. If they raise that outlook, it just provides a clear path upwards.
Now, we have to look at the bear case, too. No analysis is complete without it. What are the big risks? Is this profitability even sustainable?
That's a fair question. The primary operational risk is, well, it's actually the transition itself.
How so?
They're trading immediate cash from upfront licenses for that long-term, predictable subscription revenue.
So in the near term, that can create some volatility, some headwinds on their reported revenue and cash flow timing.
Exactly. It can confuse investors who aren't deep in SaaS accounting. But the mitigation is that it's structurally positive in the long run, and management has been very transparent about it. That risk is probably priced in.
Okay, so what about the bigger long-term risk, the competition from the giants, the hyperscalers?
That's always the one. The potential for Microsoft or AWS to just bundle these features in or acquire a competitor.
That's a valid fear. But Rubrik has some strong defenses. First, their architecture is multi-cloud. They aren't locked into one ecosystem, and customers really value that neutrality with their data.
And maybe the best defense of all is that Microsoft is already a strategic investor and partner.
Right. That alignment suggests they're more likely to partner up than to launch an all-out attack. It's a significant buffer.
And don't forget those high switching costs. Displacing over 2,500 big customers is incredibly difficult for anyone, no matter how deep their pockets are.
So when you put it all together, the thesis really rests on this perfect storm. You have accelerating subscription growth, you have the validation of their cloud strategy, and now the critical achievement of sustainable profitability.
They've built a unique product moat, and they're already positioning themselves for that next massive wave of spending in AI resilience.
The combination of those factors really does suggest a powerful growth story for the next year or two.
So the core question for you as a listener isn't really if they can execute. It's more about how long that strategic partnership with Microsoft can protect their lead. Keep an eye on how aggressively AWS and Google Cloud respond to this move into AI security, because that's the real battleground of 2027.
And if you want to keep up with the companies driving the future of enterprise software and security, make sure you subscribe to Investing Talk podcast.